Well, thank you everyone who was able to join us today. We're excited to bring you this webinar hosted by our friends at Sheppard Mullin. We are covering today ensuring lending remains fair, navigating compliance in fintech and sponsor bank partnerships. And you have a great group of panelists today that are going to share some insight, on their experience and also answer any questions you have. So if you have any questions, feel free to drop them in the chat, and Moorari will distribute them to the panelists as appropriate. Thanks so much for joining us.
All right. Thanks so much, Taylor. And great to have everyone join. We've got an esteemed group of panelists today, and I'm excited to allow all of you to hear their insights. I think one of the key things that about this particular panel is not only do they have the C-level suite expertise and strategy kind of chops, but they also are in the trenches and kind of know how these things operate on a day in and day out basis between banks and fintechs in particular. So with that, I'm gonna get started here and shift slides and introduce the panel as we do that. We've got Colin Darke, Ben Melnicki, Sarah Fernandez, and Kareem Saleh. Sorry, I mispronounced your name, Kareem. Saleh, right? Okay, got it. All right. And with that, let's go to the next slide. All these folks, many of you know, so almost need no introduction, but I'll let them provide a little bit more color on what they've been doing lately as we go through. So Colin, starting with you, if given your background leading a fintech and some of your work in the fintech space going back many years, I thought you could start us off as we dive into this topic of ensuring that fintechs remain fair, about building up a fintech and how that bank partnership works, and how the compliance strategies evolve over time. So with that, I'll kick it over to you.
I appreciate it. Yeah, Colin Darke. I have been in banking and finance and compliance world for 20 plus years. Most recently, for the folks here would care about, I was Chief Compliance Officer, General Counsel at Rocket Loans. Now I'm creating my own reg tech company that does a lot of the compliance management system automatically. And I was at Rocket Loans at the beginning when we started our bank partnership with Crossover Bank. So that does give a good progression of, I was there for 8 years as we built up from 10 people to about 150 people. And that progression of the complications and the requirements and expectations as that grows kind of gives a good context of what we're talking about today. We're talking about the fairness, and we also touched on having models and doing audits. So I initially want to talk about just the evolution of a bank fintech partnership. And when you're initially starting out with the bank, you have a sense of all your responsibilities, and the bank, like if you have a good bank partner, will give you kind of a good overview of, you have your partnership agreement. It'll give you a good overview of what the expectations are in terms of your own compliance management system and your audit schedule, and like what you're going to be expected to have in place and who you're going to be expected to engage with to make sure that you're doing the right thing and you're documenting the fact that you're doing the right thing, which is going to be a big theme of what I'm talking about and probably what others are talking about. And once you're early stage, you do need the basic regulatory compliance framework. You need your policies, procedures, monitoring, testing, trainings, and the bank will help you with that. And initially, before you even launch, kind of gauge what you have and what your path is, kind of, if as you scale, you need solutions that are going to scale with you. So when you first are launching, it's fine to have kind of some, PDFs, Excel spreadsheets, and internal trainings that are kind of making sure that the right people understand their responsibilities and you have your leadership buy-in. Once you're growing in complexity, and part of that complexity is once you're engaging with more consumers. And so that just increases your risk profile. The more consumers, the more states you are in. That's where you need a more robust team, and you need to have more robust internal controls, and you need to be able to tell down to like each, for us, it was consumer loans. So for each loan, you need to have a process in place where you're ensuring that it's meeting your and your bank partners' expectations, and they're all going through controls initially before they're funded, and making sure that they're abiding by the underwriting standards. And then you have the bank on the back end too, testing to make sure what's coming through the funnel is actually what everybody expects. And then you have at that stage, I would say, um, at least annual audits. And so, and you have them in different fields. And what we're talking about is like a model audit or a fair lending audit. And those go hand in hand. We had used Charles River, and they would come in annually. And then as the company got more complex, it would be quarterly, just to make sure that there's no growing risks, and to make sure that the lending model or the marketing model that you have is, again, like you're able to tell your client story with it. It is doing what you think it's doing, and you're proactively testing to make sure that it's doing what you're saying it's doing. And that's once you're mature, and you've gone through a few of those audits, and you've listened to, it's not, I would say, like at the beginning, early stage and mid stage, you're not really viewing the like audit as a test at the end of the year, the like one final test to kind of see, hey, have you really been doing what you've said you've been doing? And we're going to have this one very intense, scary test to see if you messed anything up. It's more of a learning to one, what your bank partner, what the regulators are expecting, and two, how you're listening to the experts that are auditing you and what their expectations are and what would make their life easier. So at the beginning, you're running kind of as fast as you can to scale and get to market. And you just don't have awareness of, and you don't have, the statistically significant enough volume to really do some of the complex testing that needs to be done on the portfolio. But as you grow, and if you're treating the audits as a invaluable learning opportunity of what will like save your company in the future and what the bank will expect, you're coming up with standards and systems to make sure that after this first audit, the next audit's going to be easier because you're following their protocols and you're documenting your policies and your model documentation the way that the auditor expects, which in turn is what the regulator will expect and your bank partner will expect. So you should listen to them. And if you're doing it the right way and you have the right people in charge of this relationship, it's going to get easier and easier. And you're going to know that even if it's an annual audit, there's going to be points in time, especially if you're buying a new model or you're testing a new theory, where you're going to bring them in more proactively to say like, hey, this is what we're considering. And they'll walk you through like how to do an appropriate test, how to appropriately document it, and like make sure that there's a pinpoint in time where if there's something that happens once you do that and it's a growing concern, like right away what happened, versus the annual look back and saying like, oh yeah, there was this growing concern. Wish we knew
So
about it 6 months ago.
yeah, let me ask you a question about that, Colin. So
Sure.
I completely understand the concept of annual audits or even more frequent audits than that. But, in the last few years, it seems like it's become pretty important to have some real-time data as well. And how does that sort of factor into not just the compliance function in terms of how real-time data is shared and whether it's vetted first or how it's done, but beyond the mechanics, I mean, what does that lead to in terms of communications? Does it enhance communications between the bank partner and the fintech? Does it potentially confuse? Are there traps for the unwary when you allow for real time data? And I guess how prevalent is it to share real time data? So if you want to attack that a little bit.
It's I'll take it a little, and Ben might have
Sure.
even a better sense of what the expectations are, and like if it's not always a good idea. I think it's always a good idea. The more data, the more transparency, the more informed decisions can be made. So while I was at Rocket, we were putting together, and I know CRB at the time too was putting together more data analytics and visuals, so you could have more of the real time. And of course, it might not mean a ton initially, especially low volume. But if you start that process and you iterate off of it to make sure that you're not seeing hallucinations and you're not seeing just white noise that's not going to really impact anything, uh, you create a dialogue. The bank's never going to do a gotcha, and you set it up in a way where as an internal counsel and an attorney, you're asking it to be set up, and you're doing the like preserving it under like work product or attorney client, so
Sure.
that it's not going to be discoverable, and you're working with Ben and the general counsel, chief compliance officer and general counsel over at your bank partner to make sure that you're gathering real-time data that's relevant and that's going to inform decisions. And then if there's concerns or something looks like it could be a growing concern, you're going to have that immediate dialogue of say like, oh, this looks like it's a growing concern, but in reality, we know what data points we're going into it, and we know it's not a true concern. We've got to document that, and like if a regulator comes, we can show them that we had this dialogue between the bank and the fintech partner, and this was a legitimate business purpose that caused what seems like a concern, and here's why it's not a concern.
Right.
And that dialogue and that relationship is critical with the regulator. So like in my scenario, we were both tracking it, we both saw something that could have been a concern, we both discussed it and worked with outside counsel and um, the experts that we have to work with, and we documented why it's not really a concern.
Yeah.
So then a regulator comes in, you show them that, and they're like, okay, you guys are good stewards. You know what you're
Right.
doing.
Right.
The
Right.
the converse is you're doing it only annually. So then you find out once a year, like, oh, that was a concern. Now we have to stop everything and kind of figure out if it's a real concern,
That's
which
right.
then you're taking people off their eye off the ball, and they should be doing other things.
Yeah.
Or the worst thing is the regulator finds that they're going through all their data on an annual audit or like a semi-annual, it's a type of audit, and it takes you a while to tell that story. It takes you a while to kind of gather all the data, and you weren't listening to your audit partners, or you weren't documenting it well, and you
Yeah.
weren't defining the data points well. So then it takes a month to get them all the data, and it gets 2 months so you can explain why it's not a big issue. And like in
You're
that 2 month time frame, the regulator is not your biggest fan, and they're not really
yeah,
trusting
yeah,
you that much.
yeah. You're revealing some scars clearly. Some you mentioned documentation being super important. Why don't we finish up this portion of the presentation with a little bit more thought, your thoughts on that and sort of some best practices around systematic documentation.
Yeah, so the best practice is working with the auditor, like having a very well-versed and trusted auditing partner, working with the bank and having a true owner of that process, of the model documentation of all the processes, so that you know that you're using a data dictionary, you know that um, you're continually compile all your information in a way that, like, if you left the company the next day, anybody else could come in and really intuitively understand what went into the model, and what how you've been testing, monitoring that model and all your systems for that matter. So it can't be just ad hoc, and it can't be kind of winging it and not following best practices and being creative in the system, like systemizing it. Like, it's got to be very regimented and uh, repeatable. And that's when I was talking to Charles River too. Like, they have like their outline of like what the expectation would be like of a model review. And so it's like as many outlines and checklists that you can have to kind of have those pauses where you're stepping back to really understand your compliance framework and your obligations is critical. And then you can have those informed strategic decisions and informed strategy with the executives and your bank partners, because you're confident in what your system's doing and saying and how it's being tested. And you're not constantly playing catch up. You're not constantly being reactive. You're being proactive because you're doing the work beforehand and you're actually listening to the experts.
Yeah, no, that's great. That's great. So let's turn a little bit to sort of what the position is of the bank. And we've got a bank expert in Ben here. So Ben, why don't you dive in a little bit more to sort of what the bank's expectations are for the fintech's compliance, and really to take us into a little bit more of the fair lending and maintaining fairness in the process that we're talking about today.
Sure. First off, thanks to AFC and Sheppard Mullins for having me. Appreciate the offer to come here and talk about fair lending, everyone's favorite topic these days. I'm Ben Melnicki. I'm the Chief Compliance Officer of Cross River Bank, a New Jersey state chartered non-member institution regulated by the FDIC on the federal level. We are, for those of you who don't know our business model, Cross River's been in business for 16 years. We are we service a lot of fintech clients. We're also a technology provider. Our banking core is something that we're proud of, and it allows us to offer innovative products and services that are designed to comply with applicable law, rule, and regulation. So, I would just say, first off, look, the slide is really just hierarchically just talking points. But I think when you're at a regulated financial institution, and a lot of what Colin was talking about, you value your partnerships, and I think the partners really truly become the meaning of that word, the essence of it. Partners, you are holding hands literally. It's I would call it a customer plus type of relationship. You're servicing them, they're relying on you to fund the loans to their customers or whatever the other activity is, but you're partners, you're in it together. So that starts with, I guess, the first thing that you really need to think about is that fair lending is foundational to your CMS, which is your compliance management system. It should be embedded in a lot, if not all or most of your decisions and processes. And I thought it was interesting. One point that stands out to me as leading a team at a regulated institution is when you're trying to find the talent, you're trying to actually build a compliance organization and team. Recruiting, it's a lot harder than it used to be right now. And I mean, I think there's no other reason for that than just the way the technology is just intrusive in every area of our lives and businesses. And I said intrusive because it's not always that we want it to be. When you think about some new and novel technologies that just sort of become a part of your everyday life. So I look for candidates that not only know the law, rule, or reg, the sort of Judge Dredd, sort of I am the law type of candidate, but they understand tech and how it works, and they also understand data. So data is key to it as well. You have to be able to work with large data sets, complicated data sets, and a lot of that involves literally working with your partners and how they provide data to you, what your expectations are. So that's just something I thought I wanted to just make clear that it's really, really becoming critical that you find the right people and that you hire right. It can't just be about knowing what subject matter expertise one has. I think we've moved past that. Other than that, I mean, I really just look, it comes as no surprise. I mean, there's really no substitute for proper oversight, which could be things like monitoring your testing program. We talked about audit a little bit. Colin mentioned, and you, Moorari, as well. But you gotta have oversight, and there's interagency guidance that we have now. All three federal banking regulators refreshed this past June. It strikes at the heart of the bank partnership model, which is a large piece of fair lending. So you need to watch your partners. So, like an example that Colin gave you, we work closely with our partners to make sure that there's adequate oversight. I think if you don't have that, that's where you're sort of playing. You're playing down 14-0, I think, to use a sports analogy. Well, I'm a baseball fan, big Mets fan, so I'm hoping New York Mets pull it out today. But look, also, I want to give my other fellow panelists a chance to weigh in here. But I look, the one thing for me as a CCO and steward of an institution is there's a lot of technology solutions around, and they're all purporting to sort of solve your everyday problems or have a solution that could solve your problems. You really, I say this to everyone listening, with all sincerity, you really need to do your due diligence. You need to pressure test what the capabilities of the vendor are, benchmark them against others and check your references. And I think, I would say, look, I'm a lawyer by background. Your contractual provisions are key. If you go to a partner, we talked about sharing data earlier.
Mm-hmm.
I think you need to be smart, not draconian about what you put in your provisions. They need to be flexible to allow for some relationships last years, and the laws and the rules and the regulations will change over time through that relationship. You need to be able to get what this is again from the bank's perspective, as the slide states. You need to be able to get or be able to obtain the data that you need from the partner and on its consumers, that as it relates to fair lending. So it's critical. It's wonky, but the TPRM stands for third party risk management. All
Sure.
those provisions that you put in, they're key. And there finally, and on a note, there really is. You could read till you're blue in the face. You can talk about politics and regulators. I am a firm believer every step of my career, there is no substitute for maintaining strong relationships with your regulator.
Yeah.
It is the difference between life and death of
It's probably the premise of the AFC. I mean, in many ways, right? I mean, this
it's
is kind of
critical.
how we. Let me just ask you one quick follow-up question, and
Sure.
and then we'll turn to 1071 a little bit, and you can talk a little bit about what may be down the pipeline for folks that are doing some small business lending. But when you talk about engaging with your partner and having those strong contractual provisions and so forth for oversight, what do you do about, you mentioned a little bit about how the laws can change and so forth, but open banking is a topic that's coming up, and how data is shared is going to be impacted by that. What's your expectation, and sort of how much lead time is it operationally sort of is necessary to adjust to changing regulations? Bank fintech partnerships have been around for a while, but they haven't, and they've always had to sort of be aware of the regulatory environment and scrutiny around certain sort of long-standing legal issues. But now we're talking about fundamental shifts in because of the technology that you mentioned and it being intrusive and so forth. what's the bank's perspective on lead time and getting to a solution that's going to be compliant within the deadlines that are, sometimes set somewhat irrationally by government?
Yeah, so I mean, real quickly, I'll go backwards. I think I'll answer it generally. It's not specific to Cross River, but I think that the general matter of a practitioner in the field. I mean, look, you got to have proper project management and planning. And I think, it harkens back to what we talked earlier about. I just think candidly, technology and how technology uses or leverages data or is able to or capable of leveraging data is one thing, but you have to plan. It's proper planning. I mean, if you're coming up on a compliance deadline for any rule, you used open banking. So I am going backwards and just, how are you preparing for it? I mean, you should not be preparing at the last minute. The institutions have working groups that they're working with one another. You have to really be forward thinking. But I think it comes down to proper planning. I mean, laws, rules, and regulations, regulatory requirements change. They could change shortly in the next coming few months too. I think it's a foundational. I think the answer is it's a foundational requirement. You have to build your organization and your program to be malleable enough to allow you to ingest new regulatory requirements and to have the foundation do that. Sometimes it's leveraging what you have in place, which is actually a good segue into 1071.
Yeah.
So I appreciate it. So 1071 is something, for those who don't know, it's a number that's thrown around. It's not a tax code or anything. It's one of the last. I sort of geek out a little bit on this larger portion of my career. Earlier was around Dodd-Frank, around Title VII with derivative reform, over-the-counter derivatives and how they were weapons of mass destruction. One of the last remaining pieces of rulemaking that hasn't been implemented yet, coming out of that 2010 legislation, which is the Wall Street Reform and Consumer Protection Act, is Section 1071 of the Dodd-Frank Act, and that talks to small business lending. And you literally, I don't think we need to spend too much time. If you're listening to this webinar, you probably know a little bit more about it than your average consumer or practitioner. But 1071, I would say, it's for small business lending. There's two purposes of it. One's to facilitate compliance and to ensure enforcement with fair lending laws, and it's also to identify certain needs for businesses and communities with opportunities for minority-owned, women-owned businesses to actually help advance them. But to tie it back to your earlier question, I mean, one thing that is really instrumental is that, and I can't stress this more, is you're talking about, again, a rule that focuses on the collection and evaluation of data. And if you're, as a regulated financial institution, receiving, or if you're a fintech receiving and sending, if you have the technology and the framework to comply with fair lending or any sort of data ingestion, you should have that plumbing in place to actually go ahead and to leverage it for 1071 for the upcoming. Now, look, some fields will change. You have to have the right, we'll call them, data dictionaries. You have to provide your partners with the right, technology built to actually ingest it the right way. But it really, in the end of the day, it comes down to, it's the same thing, set of data that you need in order to comply with the rule. And if you manage it correctly and you prepare correctly and you're in front of it, it should be something that is easily manageable, or more easily manageable than you would. And again, it comes back to technology again.
If you have a fair lending program already, it's one thing. I think there are a lot of companies that are still trying to figure out what fair lending is, notwithstanding the fact they've been in commercial lending for a long time. So
it's more than fair lending though. If you have like API connectivity, those who know, you're ingesting data through an application programming interface. I mean, you should be able to leverage that to collect the data necessary under the rule. That's really what I would say.
No, I think that's fair, and obviously we've got potentially some litigation pending and an election, as you mentioned, and we'll see how this all shakes out and how whether the scope changes for certain types of transactions and so forth. But I think the bigger picture is, to your point, is that there's this connection. There's potentially an existing platform already that exists for collecting the data. And while you should be able to adapt to new laws and regulations, 1071 is really kind of no different in that regard. And in some ways, the plumbing should already be there. So with that, let me turn to another aspect of fair lending and bring in Sarah Fernandez, who I know spends a lot of time looking at marketing, which sort of is a different, takes on a different angle within fair lending, and we're seeing a lot of focus on this, certainly with redlining cases that are focused on mortgage and so forth, being part and parcel of government enforcement these days. But Sarah, let me turn it over to you and to talk a little bit about the fair lending issues with digital marketing in particular.
Thank you, Moorari, and thank you for the AFC for this opportunity. Like you said, my name is Sarah Fernandez, so I am a Director of Consumer Compliance at Kaufman Rossin. We are a risk advisory service firm, and we partner with both fintechs directly as well as banks that are partnering with fintechs, and we provide all kinds of services. My area of focus is the alphabet soup of regulations for consumer compliance, and that includes the fair lending piece of it. And so today we're going to focus on the marketing aspect of it. And particularly, I want to focus on the digital marketing because that seems to be the hot potato right now. Whether you're dealing with traditional marketing or digital marketing, the basics of fair lending remain the same. The components of what we're trying to accomplish are the same. So, I mean, when we're talking about marketing, or if you have people in your advertisements, do you include a diversity within those people that you're displaying? And I'm not just talking about race, but also sex, age, etc. Are you making sure that you stay away from content or verbiage that's going to exclude people, a reasonable person, from applying for credit? And then, of course, for this piece, we've got to make sure that how we're distributing these marketings are that they don't exclude a protected class under ECOA, the Equal Credit Opportunity Act, or the Fair Housing Act. So that's the basics of it, and that's going to be the same for traditional or with the digital marketing. It gets more complicated with the digital marketing aspect of it because of the information that's being collected. So with digital marketing, which is your internet-based target ads, we are using consumers' information to see if they are more likely to click on an ad. So what information are we looking at here? What sites are they going to? What information do they have on their social media? What are they researching? This is not information that we would typically include in traditional marketing campaigns, but we have that information available to us with digital marketing, and so it's being used in this way, which opens up more risk in the fair lending space. So that's a lot of the risk behind it. And then the way that it works is you work with a partner, or you've developed it yourself, you've got an algorithm, and you put in specific factors that are going to target specific individuals that you feel are going to click on your ad. The fair lending risk there is in making sure that you don't have any of those factors that are going to include a protected class, again, under ECOA or the FHA. This is not new. We've seen that in 2018, I think it was, that HUD filed a complaint against Facebook for this specific area, the redlining, the digital redlining. So redlining, traditional redlining is excluding a particular neighborhood or community based on the characteristics of that neighborhood or community. And digital redlining is the same thing. We're doing the same thing, but we're using the prohibited basis under ECOA or the FHA. And so HUD filed a complaint against Facebook because it gave advertisers that specific opportunity. They could go in and pick and choose who they wanted to see their ads, and they had a plethora of prohibited basis characteristics, such as like their age, their sex. It even had, I believe, familiar status in there. So they were able to say, oh, I don't want to include individuals that have gone to parenting websites or that have looked up childcare. So you could, that's familiar status under the FHA. So all of that, when you're developing your marketing campaigns, it's important that you're making sure that those are not factors that are being included. And so that's the risk with the digital marketing.
Yeah, and Facebook was just the tip of the iceberg at that point, and then there've been so many that have followed on. I mean, folks are obviously familiar with the Townstone case that's still still kicking around, but I think you know, you've laid out a bunch of best practices here for us. I think you know, are there ones in particular that you would sort of emphasize, especially if some of the marketing is being outsourced?
That vendor due diligence is critical, making sure that you understand what your vendors are doing and how they operate, making sure that they have policies and procedures. I mean, that was something that Colin had highlighted, making sure that you have policies and procedures. It sounds very basic, but having marketing procedures is a key component of your fair lending program because it highlights to your own individual staff as well as to your regulators what you're doing to help make sure that you're in compliance with the fair lending requirements. And the same is going to apply to your vendors because they're an extension of you. You should be making sure that they also have all of these policies and procedures in place and that you are comfortable with those policies and procedures before you proceed with them. I would definitely make sure that that is part of your onboarding task list, that you're reviewing those before. If you're going to partner with a fintech, make sure that you have looked at those policies and procedures, you have a comfort level with them before you move forward.
Yeah,
I agree,
and I know.
Sarah.
Go ahead.
No, I was gonna say, I agree with everything.
She's doing your advertising for you, right,
Yeah.
Ben? So, Sarah, you know, I know you're a big advocate of testing, and sort of ensuring that this is going on. Just from a practical perspective, you've done your sort of onboarding testing or onboarding sort of checks and so forth. What does it look like on an ongoing basis to ensure that the marketing doesn't, you know, veer into that space where you might have a fair lending concern or just some other discriminatory concern? What does that entail? And then, I mean, you know, share with us some, you know, actual experiences of where things started off fine and then you know, they're just by pure inertia moved to a space where maybe it was even too late to fix and there needed to be more drastic measures taken.
Yeah, good question. So with the testing and monitoring, we are a big proponent of that because you can have the most comprehensive onboarding process in place, but then a lot can change from onboarding. And so if you're only looking at it again on an annual basis, you're going to miss a lot. So how often you're doing testing and monitoring is going to depend on your risk. So how big, how many advertisements are you actually publishing? What methods are you using to publish these advertisements? And who are you targeting? So that's really going to be the key components there to determine like your level of risk and how often. And so based on those, maybe you need to have a quarterly monitoring, and they don't all need to be so in depth, but just so that you have at least high level insight into what's going on in practice, especially if you're a bank that's partnering with a fintech. I think that that's really important. And then what that looks like, we're going to look at the specific ads themselves, again, to look at the content of what's being disclosed, the disclosures themselves, because we're talking fair lending, but UDAP is also a very key component in your marketing advertisements. And then we're also going to look at how you're determining who's going to see or not see those ads. So if you're using digital marketing, we're going to look at, do you have system parameters to show what those factors that you're supposed to be including are? And then how can we get reports to see what's being included in practice? Or do you have some kind of model validation that you're doing to prove that it's working as intended? I think, yeah. So with doing this, it's also, we're trying to make sure there should be a process in place where the fintechs themselves are reviewing these advertisements and then sending them to their partner bank to make sure that they're comfortable with it and get approval before they're publishing that advertisement. So it's really important to document when these advertisements are being published and via what method, because then we can prove, okay, it did go through the review and approval process prior to publication. And then maintain a copy of what was actually approved so that you can confirm that that's what was actually published, because that's something that we have seen is you go through this whole beautiful process, but then what's actually published is different from what was submitted for approval.
Yeah, that's great. Well, thank you very much, Sarah. Let's turn to the pictures portion of our presentation, and I'm going too fast here.
You know
Um,
what? I don't even think we need the pictures. Why don't we just like
no, the
talk
pictures
about
are the
some
best
stuff?
part. Are you kidding? Come on, we can't
Well,
leave the pictures
yeah,
out. But
we'll get to the pictures. Yeah.
so Kareem, why don't you introduce yourself and tell us a little bit about sort of what you're seeing? You're really kind of our numbers guy, our data guy, as well as our legal and regulatory sort of kind of deep knowledge, given your history in the industry. So tell us a little bit about all of what you're seeing and what you're doing to attack it.
Yeah, thanks, Moorari. Well, we're FairPlay. We automate fair lending, testing, monitoring, and optimization for very big financial institutions, teeny tiny lenders, and everything in between, including some key players in the banking as a service ecosystem. I think that, in a nutshell, what we're seeing is that fair lending testing is going from a kind of low rigor, low frequency transaction to a high rigor, high frequency transaction. And I think just like as context, it's good to remember like where a lot of these laws come from, right? And they come from the mortgage market. And if you think about underwriting in the mortgage market, largely driven by credit scores, largely driven by policies set by the GSEs, which are, as underwriting goes, relatively elementary, right? Some credit score cuts, some DTI cuts, some cumulative LTV cuts. And all of that might have made sense in a world of mortgage where the underwriting is elementary and there's so much volume and each transaction is so big that like the variance month over month may be more noise than signal. But I think in a world of increasingly alternative data, advanced predictive models, plus like a choppy economic environment where lenders are constantly adjusting their credit policies and approval thresholds to account for a kind of uncertain credit outlook, that kind of, cursory review of the data before you put it into production and then waiting a year to do a retrospective analysis, that's probably going to leave you with a lot more residual risk that many firms will be comfortable with. So what we're seeing is almost across the board in the customers that we work with, that fair lending testing is becoming happening at a much higher cadence. In some cases, we've got customers doing either quarterly or even monthly monitoring, depending on how often they test new data sources, how often they push new models, how often they adjust approval thresholds. And I think we're seeing fair lending testing going from the underwriting and the pricing and the line assignment decision to other key points in the customer journey. So Sarah's talked about marketing. Marketing is, I think, a very, very big focus. Marketing fairness is a very, very big focus of the CFPB at the moment. But we're also seeing inquiries into income verification fairness, identity verification fairness, some of these other
Wow.
some of these other high stakes decisions that get made upstream of an approved deny decision. And then, of course, heaven forbid you're in a loss mitigation or a collections situation, are the collections practices fair? So I think we're seeing growth in the kinds of decisions that are being evaluated for fairness. I think we're seeing in an increase in the frequency of the testing that's taking place. And then I think it's also important to remember that like the Equal Credit Opportunity Act applies to creditors, and it defines creditors actually quite broadly.
Exactly. Sure.
Right.
Sure.
Right. It includes, a creditor under ECOA includes anybody who plays more or less paraphrasing here, but anybody who plays a material aspect in the origination of, in the origination of the loan, including anybody who regularly refers consumers to a lender for the purpose of obtaining credit. And so I think in addition to the number of decisions that are being evaluated for fairness, we're also seeing an increase in the kinds of institutions that are well advised to do this kinds of fair lending testing.
Yeah. So why don't you tell us what's going on with this particular slide? I found it interesting. And obviously the question at the top is the data representative, but what kind of things are you finding in the evolution that you've talked about of more institutions doing this analysis, more frequency, more cadence in this? What is data representation getting better? Is there more noise? Is there more, or is the signal sort of coming through more clearly because we're getting this diversity and frequency?
Yeah. So I think one of the questions that we see getting asked a lot is, is the data representative? By which we mean, like, does the data include examples or observations of low and moderate income applicants, majority, applicants, protected class applicants from majority, minority neighborhoods, et cetera. This particular slide was one in several, and I think the ones that follow it got cut. So this is just a representation of where one of the partners that we work with does a lot of business, and you can see kind of these the bigger the graduated circles are, it means the more loan applications they receive in these areas. And this is, by the way, the training data that they use to build their models. And from this information, you can then start to compute probabilities that the data is or is not representative of these communities. I think there are some other examples of some outputs of the kinds of things that we look at. So in addition to is the data representative, I think, is there another slide behind this? Yeah. Does the data contain proxies for sensitive attributes, right? So like, are the inputs to the decisions that you are making correlated with protected status, right? Like, and if they are they also predictive of risk in such a way that like gives you a legitimate business justification for using them, right? Like, are the inputs that you're using to make a decision really those inputs, or are you actually making decisions on the basis of some kind of sensitive attribute? And then what's the third? And what's the third one? So.
Yeah, you're trying to get through all the pictures. This is. So let's talk a little bit about this, and this is kind of sort of an example slide of how you might sort of, especially if you're dealing like Cross River Bank with multiple fintechs. Tell us a little bit about specifically not just how you compare fintechs to one another. I think that's we can save that for a follow-on question. But really, how the engagement is between bank and fintech in your experience when it comes to, hey, is there a less discriminatory alternative? And what's the current sort of thinking on those types of conversations and how that's playing out in the marketplace?
Yeah, you asked two questions there. So let me talk to this dashboard right here about kind of fintech partners and sponsor banks, and then I'll talk to less discriminatory alternatives. So one of the things that we're seeing, right, and is like sponsor banks need dashboards effectively to be able to monitor their regulatory risks across the full landscape of their portfolios. And so basically what you see here is like a sample output from our tool, which is just like one little dashboard that allows a sponsor bank, for example, to look across their fintech partnerships and see the adverse impact ratios by protected class. And it's ranked them in order of the volume that fintech does with that lender. But you're right, each of these fintechs may be very different from one another. One may be a HELOC, one may be a credit card, one may be an auto loan. So there are other views that you would normally drill down into from this particular view. But this is just an example of the kind of automated reporting that sponsor banks now have available to them to identify whether some of the fintechs they're working with pose a threat either to the safety and soundness of their institutions or to the consumers they serve.
Yeah, so you see a yellow or a red and you kind of dive into there. Is that kind of
you'd be like, what's driving it? Is it related to risk? Once you control for risk, does that disparity narrow or normalize? And then, it used to be that was sort of good enough. That was kind of the end of the inquiry. But increasingly, we're seeing the question that you asked be raised at places like the OCC and the CFPB, which is, okay, well, even if there is a disparity, and even if it appears to be driven by a legitimate business justification, was there a less discriminatory alternative? And I think that's really kind of the cutting edge of fair lending analytics these days, driven, I would say, in part by the growth of cash flow underwriting, which people regard as a form of alternative data. We can quibble about whether or not that makes sense or not, but the rise of alternative data, including cash flow underwriting, plus a public fair lending monitorship that Upstart engaged in which they kind of laid out a blueprint for the best practices with respect to searching for a less discriminatory alternative. And then that Upstart public fair lending monitorship was I don't know if seconded is quite the right word, or maybe the findings of that upstart monitorship were confirmed by a study done by FinReg Lab, which is a group of former regulators from the Treasury and the CFPB,
Right.
who have also put out a study of algorithmic fairness in consumer credit, and identified essentially a roadmap for looking for less discriminatory alternatives.
Yeah.
Yeah, go ahead.
Yeah, no. So let's talk a little bit about sort of the precedent for less discriminatory alternatives, which is the adverse action notification itself and what the reasoning is that's given. I know there's been some developments over the last year or two regarding at least the Bureau's view on what needs to be contained in an adverse action notification and the specificity with which it needs to be stated, notwithstanding sort of prior guidance on that. And so what does that look like, first of all? And then secondly, how does that play into determining whether there could have been a less discriminatory alternative or not? Does it help or does it hurt?
Yeah, A and or B, yes, right? So
Right, sure.
So let's take a step back, right? So the Bureau has put out a statement earlier this year saying that they expect folks to, when they deny when consumers are denied in connection with an application for credit, that they be given a notification of that adverse action against them that states with specificity why they were denied. And I think the Bureau was responding to two things. The first thing I think they were responding to is the growing concern over so-called black box models,
Right.
and that have to be explained using approximations. And so the Bureau, I think, is concerned, rightly in part, that some of these explanatory methods may, some percentage of the time, they don't know how often, return adverse action reason codes that are either incorrect or not particularly helpful to the consumer. I think the second concern that the Bureau was responding to is there are a set of form reason codes that are, I think, in Appendix C to Regulation B. And I think that what a lot of folks in the industry were doing were like using black box models. Sometimes those models have attributes in them that they could consider to be either IP, so they don't want to disclose, or there may be some other strategic reason for not disclosing, right? Like if it's a fraud signal, you may not want to tell the fraudster,
Yeah, sure.
why you denied them. But I think that there was some concern on the part of the Bureau that, sorry, my camera's just frozen. Let me just unfreeze it real quick if I can. Yeah. I think there was some concern on the part of the Bureau that folks were using, for lack of a better term, creepy variables and then hiding behind the adverse action
The
reason
form
code,
answer.
the form answer. And so So I think one of the things that we're suggesting that people do is take a very hard look at their adverse action reason codes, and maybe even like we're helping folks compute a probability that the adverse action reason code they're giving is correct. So at least they can say, hey, look, like we know this is right 95% of the time, et cetera.
Yeah, and presumably if it's more informative, it'll help address whether there could have been a less discriminatory alternative. But that's for perhaps another day, another conversation. I'm going to turn it back over to AFC and Taylor here in a second, but I want to thank everyone for joining and the panelists for their extremely astute comments. As I mentioned at the beginning, it's an extremely well-versed group, both from a strategy and compliance perspective at a C-level kind of view, but also just in the trenches, having really done this work. And so, again, thank you for everything you've provided to us, and thank you for letting me take us through this journey. Yeah,